Hey, welcome for joining me here real quick. What are we doing? Well, we've got a tweet last week and a tweet last night about this insane little down mini crash, and that's what we called it last night. And as I sent out that tweet, the interesting aspect is the market, we have an 11-week cycle high that came to fruition last week. So, weekly highs could take a period of several weeks to retest the highs. Now, last week, what's interesting is that we did form a doji. We have yet to take that high out. But with that said, this is an unprecedented market environment where a couple things that we typically see, friends, is not associated with strong bull markets. Volatility is an old phrase. Volatility marks tops and bottoms of the market. This would be defined as a new expansion. Unlike most people were looking at the volatility index, the VIX, I'm also talking about price swings. And for price swings, we look at a function called average true range. And the average true range over the last week and a half, 2 weeks during this New Year holiday period has been unprecedented. In fact, we last night, this is not a glitch. This is the S&P futures, and that's what I'm measuring as far as volatility is concerned. When we take a look at the what I describe as the average true range, let's take a look at that right now. All right, the average true range, I'm using a 10 period in my work on my radar screen. And the S&P's, the 10-day ATR is now up to 33. A week ago, we were at 17. So the ATR has expanded from 17 to 33. Typically, expansions in ATRs, expansions, meaning markets that go up with daily trading ranges, is oftentimes associated with market corrections. Markets go down a lot faster than they go up. So therefore, when we look at a traditional, and rather than just looking at regular indicators, price-based indicators, we want to look at the condition of the market, not just looking at the volatility VIX, which is the derived, a total different calculation. What we want to be paying attention to in this case is the type of environment that we're getting trading ranges. And this is the 10-day ATR. When we start to see multiple day expansion of ATR, it's often associated with declines. Multiple expansions of ATR is associated with market declines. Expansions in ATR, market declines. Well, what's happening here is the market's doing the opposite. It's melting up, not down. You can go back in history and you can take a look at that yourself as it relates to just the S&P 500. So first, it doesn't tell us that we're out of harm's way by any stretch of the imagination from a market, susceptible to pullbacks. Anything can happen here. We obviously know the market is vulnerable and does not like warfare, obviously, right? So we don't know if the president spoke today at 11 a.m. in a news conference, and what's ironic is that he did throw out an olive branch to calm things down, but we don't know if that's enough. So again, there's going to be a heightened period of volatility, and we want to see if this I would suspect that we're not going to have an 81-point range in the S&Ps tomorrow. We're going to probably see a contraction of that volatility. But please make note that we do have an 11-week cycle high that did form last week. We haven't come off that high by a whole lot, and we are in a condition of an increase in ATR, which is generally associated with indecision in the market, selling, buying, buyers and sellers come back and forth. So we'll see if this market can start to maybe tone down a bit. Now let's take a look at another metrics that I pay very close attention to, and it's advanced decline work. In the S&Ps, what you see on your screen, just to bear with me here, is first we have the advanced decline comp ratio line. This is the advancers in the S&P, and this is the decliners. You take the difference between the two, and you get the AD comparison ratio line. Quite frankly, market's making a new high, and we're not breaking out. Could we make another new high? Sure. This is on balance volume, pretty stable. This is our volume indicator, and it's actually showing a loss of momentum of volume on this rally, which makes this market susceptible eventually for a decline, is my 2 cents. This is the McClellan oscillator, but the McClellan oscillator, this indicator is using the data from the S&P 500 because I am not trading the NYSE. And every different stock index is weighted by different stocks and sectors, FANG stocks, financials, etc., etc. So with that stated, we saw a zero line break in the McClellan oscillator, and now we're coming back to, we're still negative relative to its indicator. So what that means is, the market is neither oversold nor overbought, and it's in a susceptible level that we could get a zero line reject pattern. If the market makes a newer high, it's vulnerable for more decline. So therefore, I would have to tell you, we're not out of harm's way here, and I think it makes sense that anything can go in this market. Am I prepared for a market making a new breakout? Well, our current positions for this coming into this week, and I'm willing and have been very open about this since we've been doing our year-end webinar. We have a couple positions. Take time to put pause on this video at this point. You could see that this was a longer-term holding that we released a special report July 9th, which was 12 stocks, diversified, giving a low PE relative to the overall market, number one, best of breed of its sector, number two, and paid a dividend. Our top stocks, Intel, Target, GE, Delta, Bristol Myers, Amgen, BB&T Bank at the time, which changed their name to Truist Financial, TFC now. We had AT&T, Walgreens, General Mills, Terraform Power, Philip Morris. We made the recommendation again at the end of the year from Monday, December 23rd. I stated for that Monday on the open, do collar strategies. I gave out specific collar strategies for those top 4 names, and I said dump these top 3 names, hold the rest. Also, we are looking at a couple positions that we wanted to add into Wayfair. You guys heard me talk about that in our webinar event. Junior miners and in Occidental Petroleum, which we have increased our exposure to Occidental with a good average in. We're short on an average on IYR as of today. This would be, again, Wednesday, January 8th. I put the recommendation to dump IYR, and we took a small profit. It's heavily capitalized. It's a $90 share product. It didn't go down in the time that it should have gone down. It held. We're out of the trade. Next, we have current positions. We took a lot of our option strategies on that we had in XOP. We took half off of we took all of the 22 strikes off. That's why it says last the prior week's action. Basically, here's my current portfolio and current positioning right now. We still have our 40-50 April strikes bull call spread in Nordstrom's. Since this issue, we have dumped, here's our current positions. Nordstrom's, we are in half a position of the 24 strike calls. We paid 50 cents in XOP. They expire in March. We're going to hold on to them. We still have our ratio back spread, 50%. We took profits on half. If this thing goes worthless, we're still making money. We bought it at 2, we sold it at 6, and now if you figure that out with the math, it's a no-lose situation. Netflix traditionally rallies going into earnings season. Earnings is coming out, I believe, in around the 21st. I'm just speeding things up here. These options will allow us, and our target is around 370. Current price today is 342, so this is doing great for us. We were in a calendar spread, we bought back the short 315. We left our 317, and that's what I sent a tweet out last night saying, hey, this might be pretty good I don't like how we got down, but I like what the market's doing. I sent an email out today for all our subscribers saying, I think this is something we want to hold. It's still susceptible for pullbacks, and we have a lot more positions on that may need that hedge in case something goofy happened. And goofiness can happen in this environment. So it's 10 to 1 or the other. I think it makes sense to still have that Jan 21st 317 put on, and we'll see what happens by the end of the week with the unemployment report and, again, maybe concerns over the weekend. We're still long GE, Gold miners only a third position. Long Wells Fargo. In two-thirds position, Oxy at $41. Oxy is now trading at $45 more or less, and we dumped that REITs. One other trade that you don't know about that we put on an email alert out yesterday, by the way, was another ratio back spread in a little known company called Roku. And why in the heck would I do that? ROKU. Well, real quick, friends, here's what I like about Roku. Number one, earnings is coming out. It's still in this kind of sideways pattern. It hasn't broken out quite yet. And I think over the next 2 weeks, 14 trading days, actually 16 days, we have exposure to the upside, kind of like a free ride. So I'll do more updates on that strategy, but I'm looking at Roku, seeing a move that I think could absolutely break out of what has been a very dull event over the last 1, 2, 3, 4, 5, 6, 7, 8 weeks. And quite frankly, what my indicators and how I'm reading this is, you look at the PMC indicator, and that's this guy right here. And yes, the relative strength is going down, and yes, it's negative against the market because the trend has been down. I get that. But it's also holding this big, massive breakout candle, and typically we want to be a buyer against the midpoint of that candle, and we're wrong if it gets below the low of this candle. I'm expecting to see if by Friday we close above that high. We jumped on this trade a little early, and that's why we took advantage of a ratio back spread. You sell one closer to the money call, you buy two further out of the money calls. If the market jumps up, you have a positive net delta on the trade. If the market moves lower against you, because of that positive delta and the time, and you're short the call that's closer to the money, you can trade around this position. So it gives us a ton of flexibility and at a reduced cost to the marketplace. So that's what we got. And besides Netflix and everything else in the market, I just wanted to also point out to you, if I may, and let me bring that into speed. I wasn't supposed to get rid of everything. My bad on this. Poor recording. Fire that cameraman. All right, here's our algo optimizer on a day like today. Absolutely crazy stuff. We got out of a long position. This thing was holding a long position since 8:30, 9 o'clock this morning, all day long, which, my comments both on a hot open mic were simply, this was kind of like a shake and bake, a dump before the pump. And the fact that this market, our 15-minute model's been doing some just absolute tremendous financial damage to the market. Why did it get out here? You can clearly see it says end of day exits. That's a shame. But this is a day trade model, number one. And number two, it gets out end of day. So that's a kind of a good thing that you could see, that in case if you were long the market and you didn't get out end of day, it would have been a disaster. But this is a day trade model based on our optimization. Today, it got a nice little trade, and it got out because of the length of time holding period. That's the 15-minute model. Crude oil model did another great day. It's unbelievable. Went short, got stopped out, half of it in, half of it out, and then jumped back in. This thing is just unbelievable. You'll notice some of the targets here were hit and then compression stopped, something that we had talked about in our two-day workshop as well. So we're quite pleased with how things are going with the algo optimizer trade setups. We're very pleased on the short term. It's just, what about the longer term? I do like to take responsibility of what I say in my research and analysis. There's an 11-week cycle. It doesn't mean that the market's going to go down immediately. It means that don't be buying the high of the breakout. And that's one of the things that I believe is, for most traders, they're looking for instant gratification, and sometimes tops take longer to form than bottoms. Quite frankly, we still haven't broken out above the highs in the ES, and that's an interesting observation. And when you ask me what I mean by that, I'll share that with you right now. So this is the 60-minute ES futures model, okay? And let me go maximize this using our, of course, Thinkorswim. And you'll notice that from January 2nd, we have this huge level, this PPS sell signal, that last conditional change resistance. And I mean, is this a double top? That's the big question. And maybe we go up and we probe that and take that double top out. We want to watch the volume, and we want to watch the breadth and the condition of the market as it posts and probes this high, which is the yearly high. So again, I don't think that this is now the time to get aggressively long. We have a slew of positions on options more so than actual stocks, and I think that that is the wise choice for now. I'll update you as market conditions change, but right now I just wanted to follow up with our tweet from last night. What happened with this mini crash, and what is the market condition right now, and how are we positioned for this type of volatility? I hope that answered some questions. Thank you for listening, and have a great rest of your trading week.